Chapter 6. Accelerated Stock Strategies. 6 Ways to Magnify Your Returns. So, you want to be more aggressive with your investments. Well, hold on to your hat. We'll start slow, but by the end of this chapter, we'll be flying at Mach 3. This chapter will teach you how to invest the portion of your stock portfolio designated for your moderately aggressive basin, earning 20 to 100% on your money annually. I encourage you to put a firewall between each of your investment basins. Never dip into your long-term basin to fund a shortfall in your short-term basin, and vice versa. Each basin is sacred, designed for a specific use. Using baseball language, your long-term, low-risk basin is designed for walks, bunts, and singles, 10 to 20% return per year. Your medium-term, moderately aggressive basin is for doubles and triples, 20 to 100% per year. Your short-term, highly aggressive basin is for home runs, 100% per year and more. In this chapter, let's learn how to beat the market. Wait a minute, in Chapter 5 I told you it was almost impossible to beat the market. Yes, it's almost impossible, over a long period of time. But a large number of people have done it, on a short-term basis, and some people are doing it this very second. Don't believe me? Just for fun, stop reading, fire up your computer, and log on to www.morningstar.com. Morningstar is one of the top performance tracking services for mutual funds and stocks. Best of all, it's free. On the main page, scroll down to Toolbox and click on Fund Selector. When prompted, you want to scan all funds for 1-year returns. For example, on the day I did this search, there were 9,082 mutual funds of all types, from which the computer produced a list of the hottest funds for the previous 12 months. If you had picked any of these 20 funds, you would have more than doubled your money in that year. Wow! But 20 funds out of a universe of over 9,000 funds is only 1/5 of 1%. That's like betting on a horse with odds of 500 to 1. Would you risk the rent money for that? Sure seems tempting, doesn't it? Some people view the entire universe of mutual funds as a horse race. Some funds race off ahead while the rest of the pack trails. Then the lead horse surrenders the lead to another pony, who sprints to the front. This lead pony then falls back as yet another contender surges ahead. All the way around the track, the horses keep exchanging the lead. In this race, however, there are more than 9,000 horses, and the race ends on December 31st every year. One of the horses is called the S&P 500, which represents the top 500 companies in North America, if not the world. All other horses are trying to beat this horse. In most years, the vast majority of horses finish far behind the S&P 500 horse, especially when you factor in taxes and operating costs. Those horses that beat the S&P 500 do so only temporarily. But as the Morningstar list in Table 6.1 shows, a handful of horses finish spectacularly in the short run. The question of this chapter is, how can we locate these horses? In the next few pages, I'll share with you 6 ways, systems really, for finding funds and stocks that have the highest probabilities for not only beating the market, but trouncing it. We'll start with the easiest suggestion. System 1. Let the master himself manage your money. Who is the master of the investment world? Warren Buffett. He is without question the greatest stock investor of all time. Buffett doesn't believe in splitting his stock price, so if you want to own a piece of it, you must write a very large check for even a single share. In essence, Berkshire is Buffett's own mutual fund. A $10,000 investment with Buffett when he began in the mid-1950s would now be worth over $200 million. When he passes on to the big board in the sky, his stock price will probably take a temporary dip. This is just my guess. But then the results should continue pretty much as they have for years. Why? The co-chairman of Berkshire is Charlie Munger, who is less public but certainly as important to the success of Berkshire. The companies that he and Buffett have selected are exceptional long-term winners. The Berkshire Hathaway management team consists of only 12 people, all thoroughly trained in the Buffett methodology. As Buffett himself has written, "On my death, Berkshire's ownership picture will change, but not in a disruptive way. First, only about 1% of my stock will have to be sold to take care of bequests and taxes. Second, the balance of my stock will go to my wife, Susan, if she survives me, or to a family foundation if she doesn't. In either event, Berkshire will possess a controlling shareholder guided by the same philosophy and objectives that now set our course. You can be equally sure that the principles we have employed to date in running Berkshire will continue to guide the managers who succeed me. Lest we end on a morbid note, I also want to assure you that I have never felt better. I love running Berkshire, and if enjoying life promotes longevity, Methuselah's record is in jeopardy. Buffett further states in the owner's manual, Charlie and I cannot promise you results, but we can guarantee that your financial fortunes will move in lockstep with ours for whatever period of time you elect to be our partner. We have no interest in large salaries or options or other means of gaining an edge over you. We want to make money only when our partners do, and in exactly the same proportion. Moreover, when I do something dumb, I want you to be able to derive some solace from the fact that my financial suffering is proportional to yours. By the way, if the high-octane Berkshire Hathaway, BRKA, is too rich for your blood, you can always buy the Berkshire Hathaway B shares, called Baby Berkshires, BRKB. They were created in 1996 to fill the void of those who couldn't afford the mama stock. Each Baby Berkshire is 1/30th of the price of the A shares, with a few less benefits. A quote from the Berkshire homepage is appropriate here. If you don't know jewelry, know the jeweler. I'd add, if you don't know horses, know the jockey. Warren Buffett is the winningest stock jockey of all time. If you want to learn how to do what Buffett has done, and perhaps even duplicate it yourself, then you must read Buffettology, the book I recommended in Chapter 5. System 2. Select mutual funds with the longest term track record. If you don't want to bet on Buffett's selection of stocks in Berkshire Hathaway, then perhaps you'd like to choose another mutual fund to beat the market. Let's assume you could select only one of two funds. One fund has consistently beaten the market with a 20% per year compounded annual return for the past 10 years in a row, compared to 17.2% for the S&P 500. The second fund earned a whopping 176% in the past 12 months alone, outpacing the entire 10-year track record of the market in a single year. You're at the betting window, trying to choose between these two horses. Do you go with the hot hand or the consistent winner? Make your choice. The horses are at the gate, restless in their stalls. You rapidly juggle the numbers in your mind. If the hot fund could repeat its performance for only a few more years, you would be rich. Images of yachts and jewels and exotic places bounce around your brain. You could get used to that. Get rich slow or get rich fast. The choice is thrust in your face every day. You read a Money magazine ad boasting that this new fund burst out of the gate and grew at 52% in its first year. In the fine print, you read the familiar caveat, past performance does not guarantee future results. On the next page, a similar ad boasts a much lower one-year return, 16.5%. You flip back and forth between the ads. They both seem so real, so seductive. All things being equal, wouldn't you choose the fund with a bigger number? Remember, by the time that you read about these spectacular results in the press, the race has already been run. Can these horses do it again? For the answer to this, we dig a little deeper into Morningstar and find out how many of these winning funds were on the list in previous years. This narrows the choices down dramatically. Only 2 of the 20 were on the list 3 years in a row. If you had been smart enough 3 years ago to sink all of your money into either of these funds, the odds are about 1 in 7,000 that you would have selected the hot fund. If you go back 5 years, none of the funds did well 5 years in a row. Now we're starting to see the problem. More than likely, the hot fund this year will not repeat its success the next year. In fact, if we look at the list of the highest producing funds in each of the previous 1, 3, 5, and 10-year periods, not one fund made the top 20 in all of the time periods. Not one. In other words, the hot horse was not able to remain at the front of the pack. Of course, this is hindsight, but it sheds some light on the problem. Choosing a fund based on a short-term track record simply doesn't work. In fact, it might even be an indicator that this is the last fund you should be putting your money into. Excellent short-term results may be the clue that you should run for cover. It would be nice to be on the horse when it surges to the front of the pack and then ride it for all it's worth. But how can you find this fund before it makes its move? That's the trick. There's a way to do it, but it's fairly risky, so I'll save it for a later chapter. For now, let's go for the more conservative alternative over the past 10 years. There have been funds that have beaten the market year in and year out, over a long period of time, and it's relatively easy to find them. Once again, we turn to Morningstar and a screen of all the funds in the Morningstar database for the highest total return over the past 10 years. On the day I searched, there were 1,630 funds that had been in existence for the previous 10 years. Here's the question. How have these funds been able to pull off such long-term spectacular results? Was it the manager? Was it the fund strategy? Was it because of the bull market? Will they do as well in a bear market? Will any of these funds do as well in the next 10 years as they have in the past 10? Obviously, they've done something right. Let me give you 2 ways to narrow the list of 20 down to 1, 2, or 3 that you might be willing to put some of your money into. Number 1. Let me give you 2 ways to narrow the list of 20 down to the 1, 2, or 3 that you might be willing to put some of your money into. 1. Expense ratios. All things being equal, the fund on the list with the lowest expense ratio will probably have an edge in the long run. For exhaustive proof of this point, read Common Sense on Mutual Funds by John Bogle. 2. Industry group performance. All things being equal, the fund that has consistently performed in the top quartile compared to all other funds in the same market segment will probably have an edge over the next 10 years. Take a look at Figure 6.3. When it comes to quartile analysis, John Bogle, elder statesman of the index fund industry, has this to say in his excellent book Common Sense on Mutual Funds. When I evaluate mutual funds, and I have looked carefully at many hundreds of them during my long career, I like to look at a fund's ranking among other funds with similar policies and objectives. Morningstar Mutual Funds makes these comparisons easy. It shows in a simple chart whether a fund was in the first, second, third, or fourth quartile of its group during each of the preceding 12 years. For a fund to earn top performance evaluation, it should have, in my opinion, at least 6 to 9 years in the top 2 quartiles and no more than 1 or 2 years in the bottom quartile. I would normally reject funds with 4 or 5 years in the bottom quartile, even if offset by the same number in the top quartile. All of the preceding criteria can be determined with a little more digging in the Morningstar data. If you want to take a little more risk and venture beyond the plain vanilla index funds described in Chapter 5, then this would be a sound strategy. There is no guarantee that a fund you select this way will continue to be a winner in the future, but it stacks the odds in your favor, and probably gives you a better chance than a monkey throwing darts at a newspaper, if that makes you feel any better. System 3. Select only financial advisors with the longest track records. I've been to a racing track only a handful of times in my life. A friend of ours owned a racehorse and invited us to Del Mar to watch it run. It finished 5th. As we walked onto the grounds, there were several booths of people hawking handicapper newspapers that offered advice on which horses to bet on. Supposedly, these experts had taken all factors into consideration, the horse, the jockey, the track, the weather, etc., and were willing to share their top picks for a price. Although the stock market is not a betting track, there are hundreds of experts who will sell you their analyses. 4. Let your portfolio go to the dogs. O'Higgins' approach is deceptively simple. Rather than rooting around in 10,000 individual stocks to find the ones with the greatest chance of success, he urges us to narrow the universe to only the 30 stocks that make up the Dow Jones Industrial Average, the most widely followed stock index in the world. From this universe, he shows you how to find the few stocks on the list that have the highest probability of increasing in value in the next 12 months. All of this research takes 10 minutes per year. You make your choice, invest your money, and don't do a single thing until the next year, when you perform the same simple 10-minute calculation and reshuffle your portfolio. Sound too hard for you? Now you know why his book became so popular. People are still talking about it over a decade later. In his most recent book, Beating the Dow with Bonds, Mr. O'Higgins states, "My stock-picking system for beating the Dow is predicated upon the idea that the out-of-favor or worst-performing companies on the Dow, my pet Dow dogs, do a lot better over time than the top or best-performing ones. My 5-stock formula is the simplest way to outperforming the Dow with that strategy. It uses a combination of the highest yielding and least expensive stocks to structure a 5-stock portfolio. This has the incidental advantage of requiring less capital because of fewer stocks and lower prices. Why these 30 stocks? You can see that they are extremely successful companies that will be around for decades to come. The only trick is to determine which of them is going to do the best over the near term. Look at the list again. Without a crystal ball at the beginning of the year, how could you know which of these stocks to invest in and which to avoid? With hindsight, it's easy to see the winners and losers. The best one increased in value by 122.6%, and the worst one lost 57% in value. O'Higgins' approach is to create a small portfolio of 5 stocks that, as a group, have the greatest probability of outperforming the 30 stocks as a whole. Here is how O'Higgins tells you to do this. 1. Buy a copy of the Wall Street Journal showing the closing prices on the last business day of the year. Actually, it shouldn't matter which 12-month period you choose, as long as you do it consistently, and gather information about the closing stock price and the dividend yield for that day. 3. Rank the yields by circling the 10 highest yields. 4. Rank the circled stocks from 1, highest yield, to 10, lowest. You have now identified the 10 highest yielders in the Dow. 5. Identify the lowest priced high yielders. Put a check mark next to the 5 circled stocks with the lowest closing prices. You have now identified the 5 stocks combining the highest yield with the lowest prices. Even if these steps seem like too much work, and look up the current dogs of the Dow list. All of the selections and day-to-day performance records are right there for you, free. What did we do before the internet? Some people have written that the dogs of the Dow approach has gotten so popular that it has lost its edge, as the most recent performance results seem to indicate. O'Higgins himself has refined his approach in his recent book entitled Beating the Dow with Bonds. In this book, he still touts the power of his 5-stock portfolio, but feels that the entire market is currently overpriced. Therefore, he counsels that there are many years when an investor should not be in stocks at all, but would do substantially better with either a fully vested position in U.S. Treasury bills or U.S. government zero-coupon bonds. He states, "My beating the Dow 5-stock strategy is still the stock-picking system to beat when the investment class of choice is determined to be stocks. But it no longer responds sufficiently to the overall needs of investors in today's market because it is only 1/3 of a strategy. My new strategy of allocating assets among and between the 3 major investment sectors closes the loop by being more well-rounded. It is the complete strategy for winning, not just in today's market conditions, but all market conditions." In other words, O'Higgins recommends switching your entire investment portfolio into one of 3 investment vehicles: the 5 dogs of the Dow stocks, U.S. Treasury bills, or U.S. government zero-coupon bonds. Knowing when to switch from one investment vehicle to another is a fairly simple process. Step 1. On or about January 1, buy the latest issue of Barron's weekly financial newspaper. Step 2. Locate the section of the paper that lists the Standard & Poor's Industrial Index. Step 3. Locate the latest U.S. Treasury bond price quotations. You are looking for the most recently issued U.S. Treasury bond scheduled to mature in 10 years. Step 4. Do some simple math. Add 0.30% to the number from Step 3. Then compare this number to the figure circled in Step 2. If the stock yield, 2, is higher than the bond yield, 3, this is your signal to invest your money in stocks that year. Just follow the 5 dogs of the Dow strategy mentioned earlier. If, however, the bond yield is greater than the yield on stocks, this tells you that stocks are overpriced and ripe for a correction. Your money should be invested elsewhere. Exactly where you invest your money depends on the price of gold. Don't ask me why, but O'Higgins has done the research to back up his selection. Step 5. Go to the section of Barron's, which lists the gold and silver prices, and note last week's price of gold per troy ounce. Also, circle the price of gold as of 1 year ago, as illustrated in Figure 6.7. Step 6. Compare the price of gold last week to the price of gold 1 year ago. If the price of gold is higher last week than last year, then invest 100% of your available money in U.S. Treasury bills, due to mature a year from now. If the price of gold is lower last week than a year ago, then invest 100% of your available money in U.S. government zero-coupon bonds that are due to mature in 20 years or more. Then, according to O'Higgins, Sit back, relax, and do nothing but watch your returns come in for the next 12 months. Then, on or about January 1st of next year, go out and buy Barron's again and revisit your investment strategy. Follow the same procedure every year thereafter. And that's all there is, folks, to my new Beating the Dow with Bonds strategy. Told you I kept it simple. To show you how powerful the strategy would have been over the past 30 years, as soon as the dogs of the Dow became popular, other people came out of the woodwork with their own selection process for picking the right stocks from the Dow 30. The Motley Fool duo of David and Tom Gardner came up with a variation called the Foolish Four that they track on their website. There is a huge difference between the top stock of the Dow 30 and the bottom one. 122.6% and minus 57% is a massive swing of 179.6%. Therefore, it's worth the effort to come up with any kind of system that works. System 5. Consider enhanced index funds. So far, we have looked at 4 strategies. Strategy 1. Riding the coattails of a single-time tested brilliant investor, the legendary Warren Buffett. Strategy 2. Relying on the management of mutual funds with the best long-term track records. Strategy 3. Relying on the financial advisors with the best long-term track records. Strategy 4. Buying the lowest-priced, high-yielding dogs of the Dow. I asked my friend and mutual fund guru, Bill Donahue, what he thought of these strategies. Bill is one of the world's premier financial advisors over the past 20 years and author of 10 national bestsellers, with 1.2 million copies of his books in print, including the No-Load Mutual Fund Guide and Donahue's Mutual Fund Superstars. Here's what he wrote. Well, Robert, as an investor, you have to make your money in the future, not in the past. Your choices are all time-tested favorites and well-respected among the wisest investment advisors. However, each of these strategies assumes the past is indicative of the future. Already the past decade has shown that older, once exciting mutual funds and strategies have become too large to maintain their competitive advantage. Today, they hold too many of the same securities. Age often brings wisdom and respect, but not necessarily the ability to recreate success. Then he added, the day of the stock picker is over. The day of the index picker has arrived. Donahue reached this conclusion because of several major trends that have been overlooked by many financial advisors. Trend 1. Over the past 5 to 10 years, only 18 of 3,772 managed no-load domestic stock funds have been able to beat the average performance of the Standard & Poor's 500 composite. With all their so-called sophisticated investment analysis and investment savvy, 99.5% were unable to beat a simple S&P 500 index fund like Vanguard 500 index investors. Trend 2. The baby boom generation is investing more and more of its retirement savings in the stocks of fewer and fewer companies. The 500 largest corporations in America, the S&P 500, of today are probably the S&P 2000 of a decade ago. This demand, focused on fewer and fewer stocks, is driving the prices of large capitalization stocks higher and higher. Trend 3. There is a greater and greater concentration of investors' dollars in index funds like Vanguard 500 Index Investors, which is now the largest fund in the world with $90 billion in assets. Most of the growth in value in the past decade has been confined exclusively in the large cap stock market defined by the S&P 500 composite and the NASDAQ 100, the 100 largest over-the-counter OTC stocks. Trend 4. Over the past few years, we have seen that the emergence of a new breed of mutual fund allows the individual investor to take advantage of these trends, which are likely to continue well into the new millennium. Enhanced index funds. What is an enhanced index fund? To answer this question, we need to do a little review from the previous chapter. This is so important that I want to make sure you truly understand these concepts. A stock market index usually describes the weighted total market value of a specific group of stocks. Here are some examples. The Dow Jones Industrial Average is a large cap index of 30 large company industrial stocks. The S&P 500 Composite is a broader large cap index, the 500 largest stocks, which make up about 70% of the market valuation. The NASDAQ 100 Composite, also referred to as OTC, over the counter, is a mid-cap index. The Russell 2000 is made up of the 3,000 largest stocks less the largest 1,000, therefore it is a small cap index. The term index fund refers to a mutual fund that invests its portfolio with the investment objective of tracking or duplicating the movements of a specific stock index. Vanguard 500, VFINX, is such a fund. Its objective is to approximate the total return of the S&P 500 Composite Index. The term enhanced index fund refers to a mutual fund that invests its portfolio in an attempt to earn a multiple of the index it tracks. For example, the Rydex Nova Fund, RYNVX, has an investment objective of earning 1.5 times the return of the S&P 500. Investing in the actual stocks included in the stock market index would achieve a total return only equal to or close to the index. To earn 1.5 times the index, it is necessary to invest about 10% of the fund's portfolios in overnight options and futures and 90% in overnight repurchase agreements, repos, as defined by their investment strategy. Repos are one of the very safest investments available, both the purchase of and the agreement to repurchase the underlying securities a day or so later are executed simultaneously. The futures and options give the fund its investment power and, at the same time, its volatility. Did you catch that? In other words, an enhanced index fund has a way of supercharging the returns of an index fund. This also means that from time to time it may supercharge your losses. However, if you invest in an index fund because it is broadly diversified and beating nearly all of the managed mutual funds, and if you think the stock market will continue to rise, and if you are willing to be patient for the long term, why not attempt to earn 1.5 times as much as the ordinary index fund, as in the case of Rydex Nova? The ride may have a few more and larger bumps along the way, but you will arrive in a brand new Cadillac instead of on a bicycle. Leveraged funds, most of which are quite small, guarantee serious extra bang for your buck. 125%, 150%, even 200% of index returns. The bang comes from derivatives, the index options and futures that can be bought with only a small down payment on a contract's value. A targeted return is achieved by combining options and futures with cash and underlying stocks. ProFund's Ultra OTC Fund, which seeks to double the return of the NASDAQ 100 index, jumped 185.3% last year, while Potomac OTC Plus rose 104.2%. Leverage, of course, cuts both ways. As exciting as it can be on the upside, it can be equally as bad on the downside, says Kevin McDevitt, an analyst with Morningstar Inc. While these funds weren't designed for mom and pop, they are attracting a wider audience. A growing number of individuals, rightly or wrongly, feel sufficiently savvy to handle the huge risks. According to Donahue, if the trend toward the domination of the stock market by the S&P 500 largest stocks continues, and if that stock market sector continues to rise, why not bet on the S&P 500 continuing to rise and earn 1 to 2 times the return of the S&P 500? If over the long term, over 99.5% of all the managed funds have not been able to beat an unmanaged index fund like Vanguard 500 Index Fund, then put your money there and forget the managed funds. If investing in the Vanguard 500 Index is good, then investing in Rydex Nova, which seeks to earn 1.5 times the S&P 500's return, may be better. If Nova is better, then investing in ProFund's Ultra Bull, which is geared to earn 2 times the S&P 500 return, might be better still. At least that's the way it's supposed to work in theory. Most of the leveraged funds have difficulty reaching their targeted goals. Goals may be inspirational, but only performance is spendable. What's the downside? What if the stock market goes into a dive, a steep correction? That's where reading the market's momentum is everything. If you can recognize the correction early in the game and get out of the market or into a negative beta fund, you can make some extra money. If you can recognize the recovery as well, you can make excellent money from the volatility. Both are very difficult and emotional trends to detect and act upon, even by professionals. And this is where Donahue shines. Donahue's advisory firm, W.E. Donahue and Company, Inc., WEDCO, has been managing money since 1986 and currently has over $100 million under management. Their minimum relationship is $100,000. Using unique and proprietary, i.e. secret, formulas Donahue has created a portfolio of enhanced index funds, which he calls his bull and bear portfolio. By moving in and out of certain funds at very specific times, his bull and bear portfolio earned 222.5% in 1999. These returns were net of all investment costs and management fees. For the same period, the S&P 500 was up only 22.1%. Donahue recommends that a good middle ground to beat the S&P 500 is to put 60% of your money in Pro Funds, Ultra OTC, or Ultra Bull, and the rest of your money in your favorite income investment. The total of the two should exceed the NASDAQ 100 or the S&P 500 return, respectively. If either reaches its goal of earning twice the index, a 60% position should earn at least as much as the index. If you take the other 40% and invest it in your favorite income fund, you are almost certain to have a total return in excess of the index. And, if the current index fund leadership trend continues, you'll equal or beat the return of nearly every managed stock fund in America. More important, you have the potential of beating the S&P 500 without the event risk. The risk of a single event, like negative news or rumors of news about a single company impacting a stock. Of a single speculative stock holding. Effectively, you may enjoy greater returns than in a single stock with a broader diversification among the stocks in the index. Are enhanced or leveraged index funds for you? They may be an interesting alternative for aggressive investors. Do your homework and read the mutual fund prospectuses before investing, of course. Caution. All of the preceding benefits are derived from profits earned from securities. Past performance does not guarantee future profits. Investment should be made only with the advice of a qualified financial professional. System 6. Consider high-powered stock sector funds. When a professional investor looks at the entire market, he or she can view it either vertically or horizontally. Vertically. By size or market capitalization. You choose among various index funds, large cap, mid cap, and small cap domestic stock indexes, European or Asian stock indexes, or returns tied to the value of the 30-year Treasury bond. Horizontally, by industry or market sector, you choose among various sector funds, utilities, energy services, electronics, financial services, technology, etc. What is a sector fund? Investors Business Daily lists stocks in 196 industry groups or sectors. Depending on the economy, industry groups can be either in demand or out of favor with the market. If an individual stock happens to be in an industry grouping that is out of favor, it may have a dampening effect on those stocks' price performance, and vice versa. Managers of sector funds try to build a portfolio of the strongest stocks in a single sector. Investment advisors who serve as managers of portfolios of sector funds, like Donahue, try to invest in a few of the strongest sectors for their clients. The funds won't change their stripes regardless of market trends, but the investment advisor can change the funds he or she holds. If you look at a list of the hottest mutual funds in the past decade, it's pretty impressive. Notice how many of them are sector funds and which fund family dominates the list. Fidelity Select Portfolios currently has the largest selection of sector funds, offering a choice of 39 individual sector portfolios, which range from the multi-billion-dollar conservative sector funds like their utilities portfolio, to smaller, more speculative sector funds like medical delivery. Fidelity Select Portfolios is unique in that it charges a one-time sales charge of 3% to invest in the program. Once your money is invested, there are no new sales charges unless you invest more money in the program. The one-time sales charge, however, gives you the run of the house. Fidelity's house is a mansion. It has hundreds of funds to choose from. I asked Bill Donahue how he decides which ones to watch. He replied, "We follow about 60 sector funds, defining the word sector a bit liberally. We follow the Fidelity Select Portfolios, single country international stock funds, regional international stock and bond funds, and some specialty funds, which Fidelity offers. Fidelity Export is a fine example. Once we have paid the 3% entrance fee, we might as well use all of the funds available to us. Some investors don't want to pay loads of any kind, so they choose to use the much more limited lists of no-load sector funds at Ridex and Invesco. We are watching those families, but currently we like the broad range of choices we see at Fidelity. where we have more clout for our clients because we have millions of their money at Fidelity. Remember, I told you earlier in this chapter that choosing a fund based on a short-term track record simply doesn't work. It would be nice to be riding the horse when it surges to the front of the pack. But how can you find this fund as it begins to make its move? That's the trick. How can you know which of these sector funds is going to be hot in the near future? Once again, we turn to our mutual fund guru, Bill Donahue, for the answer. He writes, "In what investment funds shall I invest?" Ah, that is the great investment question. The answer is actually surprisingly simple. Follow the stock market's price trends. The market itself will tell you where it is paying the best returns. Regardless of stock market experts' predictions, the stock market's movement is the reality with which we work. The market is always right. Sometimes finding the stock market's direction and future trend is simply looking at where it has been recently. The long-term trend in the stock market is obviously upward. Inflation alone will most likely drive the market up over time. In the very short term, day to day, the stock market can be very unpredictable. Some days it is up, some days it is down. But contrary to what most believe, even in the bull market, the stock market is down about 40% of the days. That's sweet spot. But somewhere there is middle ground, where you can identify the sweet spot among intermediate term trends, where the advice is just right to make profits most of the time. That's all you need, to pick up the intermediate term trends, the trends that, most of the time, last for weeks on end. Even then, you can expect to identify only 60 to 70% of the trend. You will, of course, miss the beginning of the trend because it will have just started. You will, of course, miss the reversal of the trend because the trend takes time to establish itself. However, if you can find that sweet spot, the intermediate term time period over which you can identify the greatest portion of the trend most of the time, then you have added some significant value to your investment strategy. If you can then combine that analysis with leveraged investments such as enhanced index funds and carefully selected sector funds, you can magnify that advantage into a major investment opportunity. How major of an opportunity? Donahue manages 2 portfolios of sector funds, his diversified sector fund power portfolio and his targeted sector fund power portfolio. The diversified sector fund power portfolio chooses 4 funds from a universe of 60 sector funds and stays with those as long as they remain in the top 10. The universe he chooses from includes 38 Fidelity Select portfolios, plus selected specialty funds, international single country funds, and regional stock and bond funds. The targeted sector fund power portfolio selects a single fund from a limited universe of 5 carefully screened sector funds, a tighter focus, but at the same time it has the potential of earning greater returns. Over the past 12 months, using what he calls reality-based momentum investing, his portfolios have been up 86.7% and 96.1% respectively. I couldn't get him to reveal all his secrets, but Bill has graciously agreed to share with you a few tips to help you choose a portfolio of selected sector funds to enhance your investment returns. Using our special brand of reality-based momentum investing, we focus on only the most recent price trends to identify the funds whose value is accelerating at the greatest rate, and then we remain invested in those investments until another investment's current price uptrend is stronger. This often means that rather than overstaying our welcome in a specific fund whose momentum is slowing, we most often reinvest our money in a different sector, which is taking new leadership. Most trades are initiated for a positive reason, new leadership, rather than a negative reason, reversal of trends. There are, of course, no guarantees. Our track record speaks for itself. If you're trying to accomplish this task by yourself, here is some specific advice which I hope will be of use to you. Allow me to give you an oversimplified version of how my analysis and myself go about selecting investments for our 3 power portfolios. First, we select our fund universes. For the diversified sector portfolio, we select among a universe of 60 sector funds. For our targeted sector portfolio, we select among a universe of 5 carefully selected, non-correlated, they don't move in concert, sectors. For our matrix bull and bear portfolio, we select from among 38 Ridex index trust funds. Then we rank the fund's performance by comparing how fast their returns are accelerating. To do this, we take, for example, each fund's annualized performance over the past, say 7 days, and compare it to their performance over, say, the past 28 days. If it is earning profits faster in the past week than in the past month, then its performance is accelerating, growing faster and faster. We rank the funds in each universe and then select the top 4 funds in the Diversified Sector Fund Portfolios universe, the single top fund in the Targeted Sector Funds Portfolio universe, the single top fund in the Bull and Bear Power Portfolio universe. Finally, as long as the 4 funds we picked and diversified remain in the top 10, and we hold at least our minimum period, we stick with them. If one drops out of the top, we replace it with the best fund that we don't own. In the other universes, we require the fund to stay in the top 2 or we drop it. These strategies all have minimum holding periods, which avoids a lot of volatility. We make these decisions each week. Evaluating each day or each month would, according to our research, cause us a lot of unnecessary losses. A week seems to be a comfortable review period. We then keep an eye on each strategy to see if we are satisfied with its performance. After all, it is only a mechanical strategy, and we manage people's hard-earned money. However, it would take something extraordinary to override our successful strategies. Well, I hope you have enjoyed this very valuable peek into the mind of a top money manager. As you can see, Donahue has done his homework. Remember to read his prospectus and talk with his personal asset managers before determining which combination of power portfolios is for you and whether you should try to do this yourself. To summarize, Donahue's approach is to tap into the rhythm of the market and let the market tell him where it is going. So far, his returns are impressive. However, this active trading can generate a lot of tax consequences, or short-term profits on which taxes must be paid in the current year. Donahue's strategies may have the potential to earn more after taxes than most strategies do before taxes, so that may not be a major issue. In addition, when we get to Chapter 15 and discuss saving money on your taxes, I am going to ask Bill Donahue to tell you how your portfolio profits can be 100% income tax deferred and possibly even 100% income tax free. You won't want to miss this. Investing strategies in the new millennium are going to be very exciting, and well, they should be. We are all facing the reality that we will live longer and prosper. That has a familiar ring to it.